Welcome to this explainer. Okay, today we're going to dive into the absolutely fascinating world of one of Europe's purest value investors. I'm talking about Robert Vinall. We're going to look at exactly how he breaks through all those noisy, traditional Wall Street rules to find just massive returns. Honestly, it's a masterclass in concentration, conviction, and basically being willing to look completely wrong to the rest of the market until you're proven undeniably right.
Section 1. Blocked from the value. So, to really understand his breakthrough approach, let's start with a very literal, everyday frustration I'm sure we've all faced when we're just trying to browse the internet.
You definitely know the screen I'm talking about. Sorry, you have been blocked. It's that classic Cloudflare security error. Now, why does that actually happen? Well, the text usually tells us that certain actions trigger the firewall, things like a weird SQL command or, crucially, malformed data. And you know I love this because it's a perfect metaphor for how conventional investing rules actually work. Traditional finance has these rigid firewalls built in. They have unbreakable rules demanding intense diversification, and they'll heavily punish fund managers for tracking error, which is just a fancy way of saying you deviated too far from the average benchmark index. So if you don't fit into their perfectly average mold, you're treated as malformed data and summarily blocked from their definition of success.
That brings us to Section 2, Extreme Portfolio Concentration. Let's see how that malformed data metaphor plays out with Robert Vinall's fund RV Capital, especially looking at his first quarter in 2026. He completely ignores that golden rule of diversification.
All right, let's put this into perspective. $382 million. That is the massive total value of Vinall's portfolio. Now, traditional finance rules scream that you need to take a pot of money that big and spread it paper-thin across dozens, maybe even hundreds of stocks just to protect yourself. But Vinall, he takes that entire fortune and distributes it across just 13 total positions. Yep, 13. That's it. He's clearly not looking for the safety net of diversification. He's going all in on deep, unshakable conviction.
And that extreme concentration is just undeniable when you look under the hood of his Q1 2026 portfolio. I mean, he is not dabbling here. Carvana and Meta alone eat up over half of his total capital. Add in Credit Acceptance and Interactive Brokers, and just those four companies form the absolute bedrock of his strategy. Even after slightly trimming his fifth largest holding, H World Group, his top 5 positions make an astonishing 87% of the entire fund's value. The top 10? That's 99%. He is making massive bets that leave literally zero room for filler.
What's wild is he's actively doubling down on these convictions too. In the first quarter, he made huge additions to his smaller tech positions. Take Microsoft. He bumped it up by a staggering 119% from the previous quarter. Now, actually, to be fair, that still represents a smaller 2.5% slice of his total pie, but the growth is huge. He also bumped Paycom Software up by 72%, Salesforce by 41%, and aggressively poured 24% more into his already massive top position in Carvana. Plus, he brought a brand new target, Morningstar, right into the mix. He doesn't just hold on to his winners, he feeds them.
Section 3. Use a shovel, not teaspoons. Okay, so the crucial question here is what kind of underlying philosophy actually allows a fund manager to confidently place heavily concentrated bets like that without, losing sleep?
Well, it really comes down to a fundamental shift in mindset. The conventional approach on Wall Street treats trading stocks like you're just buying pieces of paper, constantly swapping them around, hoping the price wiggles upward over the next couple of months. But Vinall, he operates strictly on the business owner philosophy. He doesn't see himself as buying mere stocks, he considers himself a true owner of a business. He's looking for highly resilient companies, run by rational, long-term leaders, and when he buys in, he intends to hold those stakes for decades, not just a few quarters.
Which brings us to a brilliant guiding principle borrowed from the late, legendary investor Charlie Munger. Use a shovel, not a teaspoon. Vinall deeply believes that truly exceptional, once-in-a-lifetime business opportunities are incredibly rare. Most of the market is literally just noise. So when you actually find one, a resilient business capable of huge long-term value creation, you don't scoop it up cautiously with a little teaspoon. You bring a shovel, you dig in deep. That extreme concentration we were just talking about, that is the shovel at work.
And here's where Vinall completely redefines investor psychology. The standard advised on Wall Street is that you need this innate temperament, basically ice in your veins, to handle a concentrated portfolio when it drops 20% in a single month. But Vinall argues that lasting success isn't about having some cold, innate emotional control at all. Instead, it's entirely about structural design.
Let's define what that actually means. Structural design is the conscious act of setting up the fund from day one and carefully selecting aligned investors who have very long time horizons.
By designing the whole ecosystem of the fund this way, he completely removes the block of short-term performance anxiety. I mean, think about it. If his investors aren't panicking about quarterly dips, he doesn't have to panic. It gives him the ultimate freedom to just entirely ignore short-term market volatility.
Part 4. Contrarian bets and transparency. Because of that structural freedom we just talked about, Vinall is empowered to take on contrarian bets that your average fund manager would be absolutely terrified to touch. Just look at his massive 31.1% stake in Carvana. And remember, he added another 24% to this position this quarter. Carvana is not your classic, boring, safe value stock. They faced massive market criticism and heavily scrutinized leverage issues, meaning they took on a lot of dangerous debt in the past. But Vinall, he invests right through those temporary operational struggles. He's totally willing to back companies that are ignored or even outright hated by the broader market, as long as he believes the underlying business model is fundamentally sound.
And he pairs that contrarian bravery with what I can only call radical transparency. In an industry where managers constantly hide behind benchmark indexes to justify their mediocre returns, Vinall really stands out. He writes these detailed annual letters that investors read almost like manuals for critical thinking. In them, he openly admits his errors, like he fully acknowledged his past mistake of underestimating Carvana's debt. He doesn't hide. He breaks down the logic behind every single move he makes.
Section 5. Ultimate Compounding Machines. All of this brings us to the final takeaway of RV Capital's strategy and how we can apply these lessons to our own understanding of long-term value.
By breaking through those standard rules, those security blocks of traditional finance that keep everyone else safely stuck in the middle of the pack, Vinall manages to just cut out all the background noise. In a complex market, he simply doubles down on his strongest convictions. He concentrates his capital strictly into a handful of what he considers to be unbeatable compounding machines, businesses that just relentlessly generate and reinvest their own cash to grow exponentially.
As we wrap up this explainer, I really want you to take a hard look at your own financial choices and the blocks you might be letting restrict you. Think about Robert Vinall's 13-stock portfolio and ask yourself this: are your investments structurally designed to break through the noise and truly compound your wealth, or are you still just playing with teaspoons? Thanks so much for joining me today. Keep learning, and I'll catch you in the next one.